I think the word recession is a word that's inappropriate because it's just a word that the certain people, I'm going to be kind, certain people in the media are trying to build up because they'd love to see a recession. We're very far from a recession. In fact, if the Fed would do its job, I think would have a tremendous spurt of growth.
Joining us now, my next guest is Stephen Gallo, head of FX strategy at BMO Capital Markets. His behaviour is always exemplary. Stephen, is it inappropriate to countenance, to think of, dare I speak the word recession, as the president suggests? What do you reckon?
Well, I would say it would be foolish to admit that the risks of recession in the U.S. are zero. The risk of a recession in the U.S. is clearly not zero. It's lower than in other parts of the global economy. But you know, this is a trade war, and there are costs to all sides in any type of a war. The point is that at the end of the war, the victor will be the side that incurs fewer costs and fewer damages. So it's a long, hard slog ahead into the 2020 U.S. general elections, I think, Manus.
It certainly is going to be a long, hard slog. And you would also make the point, and this comes back to the broader concept, in a war of salvos, who wins and who's got the most ammunition. You would say, and if I'm not wrong, you would say PBOC over the Fed. And this is about who has the most ability to push back. Is that a fair summation on your base case?
I think PBOC has plenty of levers. Regulators in China have plenty of levers to manage domestic policy risks. That doesn't mean that they won't lose control. There's always a chance that they can lose control, but they have much more control over the currency today than they did in 2015, 2016. But I think the main issue that we're not talking enough about is the issue of a potential shortage of dollars in the global system. And this is because the forces that were in play in the run-up to the global financial crisis, which were largely dollar negative, and then, of course, in the immediate aftermath of the GFC, when the Fed was pumping huge amounts of money into the system via QE, those forces were dollar negative because of trade and various other factors. Those forces are now going into reverse. So although there is not, I would say, evidence of an acute dollar shortage, there is a risk over the coming 12 months of one materializing. The trade war ultimately means that exporters based in the People's Republic of China, these are Chinese-owned exporters that export to the U.S., they will ultimately, most likely, take in fewer dollars as a result of their exports, as a result of the U.S. tariffs. And then, of course, you have HKMA selling dollars on occasion to defend dollar Hong Kong from going up above the top end of the band. Yeah. And then you've got the demand for dollars because many emerging markets, state-owned companies, governments have loads of dollar-denominated debt. So it's a global problem. It's a global problem, and we need to keep that on the radar screen.
How is that going to potentially manifest itself, Stephen, if there is that lack of dollar liquidity? Where is that squeeze going to be manifest, first of all? Is it through, and forgive my naivete, is it going to be through the FX channel, or is it going to be through, presumably through the rates channel, first of all?
I think it would probably be more of a funding issue rather than an issue for spot FX markets. But the second leg of it could be dollar strength, simply, you know, just out of fear of investors not wanting to own anything but basically dollar cash, or have their money in gold or in a dollar-denominated bank account, or maybe even in a Swiss bank account where they have to pay minus 0.75% annualized in order to do that. We're not there yet, and the Fed has levers and rhetoric that it can use to try and prevent an acute situation from happening. But we're closer to that situation today than I think we've been in this cycle.